Does my co-borrower credit score matter?
Yes, your co-borrower's credit score does matter. This is not like a car loan where you can get someone with better credit to co-sign for you, and we would lend money based upon their credit score. The borrower and co-borrower on a mortgage loan both have to credit qualify. Um, it will affect the interest rate, it will affect the terms, it affects everything. So we look at the pay history, we look at the credit score, we look at the same things we would if you were a primary borrower.
What type of loans are there?
We have FHA loans. There are conventional loans, Freddie Mac and Fannie Mae, which you probably hear about them in the news. There are VA loans that are administered by the Veterans Administration, and there are USDA loans that are handled by Rural Housing Development.
How long of a work history should I have?
You should have a 2 year work history, but there is a caveat to that. But you have to join the class to find out the caveat to that.
Can I buy a house if I'm self-employed?
Yes, you definitely can buy a home if you are self employed. And that is something that I spend a lot of time working through with my clients on a one on one basis because a lot of people have a hard time qualifying if they're self employed. But I have a certain level of expertise of structuring those deals.
What's the difference between being pre-qualified and pre-approved?
The difference between pre-approval and pre-qualification is when a loan is pre-qualified. We just don't look at the borrower's credit and issue a pre-approval. The pre-qualification process, the loan is processed to a certain degree by a mortgage processor, and there's some preliminary underwriting done. We look at the borrower's income docs. We check their employment history. We look at their credit and some of their assets. So we actually take into consideration a lot of the categories that we use to make the lending decision and issuing that pre-qualification.
What happens after you get pre-approved for a home mortgage loan?
The pre-approval allows you to shop for a home loan with a realtor. Be mindful that that pre-approval does have an expiration date, and the docs will expire usually after, on average, about 90 days.
When should I refinance?
You can refinance your house after you have made 6 payments, and that does not mean 6 months after you have had a home you can refinance. For FHA, you can refinance in as little as 6 months after you've made 6 payments, and Fannie Mae and Freddie Mac, you have to you can do a rate and term finance after 6 months, but in order to cash out, you have to wait a little bit longer, and we talk about that timeline in our class.
Once your loan process gets started, what documents are needed to provide for proof for purchase and a refinance?
We need your income documentation, which includes your pay stubs, your W-2s, your tax returns. We also need we need proof of your identity, which would include your social security card. We would need your driver's license. The other documentation we would need is current pay stubs, your employer's telephone number, and your bank statements to provide the assets so that we can see where the money for the down payment and closing costs is coming from.
What is an interest rate?
An interest rate is the money that we charge the borrower for borrowing the money. So if your interest rate is 4% on $100,000, that is the 4% interest rate that we're charging for lending you the money.
What does it mean to lock in your interest rate?
When you lock your interest rate, interest rates change and fluctuate daily based upon the market. So when you lock in your mortgage rate for a certain time period, you're locking in, you're guaranteeing yourself that rate for 5 days, 10 days, 15, 30, or more days.
What is the loan estimate?
The loan estimate replaced the good faith estimate. The loan estimate is provided to the borrower, and it's the summary of the charges that they will be charged from the lender, from the title company, from the county or the city that they lived in, and the money that we use to set up their escrow accounts.
What does debt to income ratio mean?
The debt to income ratio is the amount of debt that you have, um, and that would include student loans, credit cards, car loans, other mortgages, compared to the money that you bring in, the gross amount of money that you bring in every month.
What is an appraisal?
An appraisal is a evaluation of the collateral. So it is the valuation tool we use to determine how much your property is worth.
Is homeowner insurance optional?
Homeowners insurance is mandatory.
What are points?
Points is a percentage of the loan that is charged to you by a bank for doing the loan. So a point equals 1%. So if you're charged 1 point, and it's $100,000 loan, it's $1,000.
What is your average loan processing time?
I would say the average loan processing time would be about 30 to 45 days, realistically.
How long does it take to close on a house?
I would say that I've seen properties close in as little as 28 to 30 days. And if it's new construction, you may have to wait until the property is finished. So that could be as little as 30 days or as much as 6 months.
And how is paying a mortgage different from paying a rent?
Your mortgage payment is going towards paying down the loan that you borrowed for the house that you own. And your rent payment goes directly to your landlord to help him pay off the mortgage on the house that he owns. And that is the difference between a mortgage payment and a rental payment.